Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Tuesday, October 14th. The stock market saw some swings on Tuesday, eventually settling with a modest loss after the government's latest financial relief efforts were offset by fears that the broader economy will still face challenges. Some investors decided to take some money off the table following the previous session's massive gains, which added to the selling pressure. The S&P 500 opened at its highs with a 4.1% gain, fell to a loss of as much as 3.1% in the final hour of trade, and then recovered to finish with a modest loss of just 0.5%. 8 of the 10 economic sectors posted a gain. A strong 6.4% advance in financials, aided by the government's relief plan, helped offset weakness in technology, which was down 3.9%, materials, which fell 3%, and small cap stocks, which were down 2.9%. The weakness in technology caused the Nasdaq to underperform with a loss of 3.5%. With regard to the government's efforts, the Treasury will buy up to $250 billion in preferred stock from qualifying U.S. financial institutions, with the funds and authority coming from the $700 billion plan authorized by Congress earlier this month. To participate in the program, financial institutions will have to agree to executive compensation limits, including the elimination of golden parachutes. Participation in the program is voluntary, although it appears that firms will be taking the Treasury up on its offer. 9 of the largest financial institutions in the world will receive $125 billion, including Bank of America, Citigroup, J.P. Morgan Chase, Morgan Stanley, and Wells Fargo. In addition, the FDIC will guarantee the newly issued unsecured debt from banks through June 30, 2012, meaning that if a bank fails, holders of newly issued debt will be paid by the FDIC. This includes interbank lending, which had seized up as banks hoarded cash. Separately, non-interest-bearing deposit accounts will now be fully guaranteed, up from the current limit of $250,000 until the end of 2009. Credit markets showed some signs of improvement, although they do remain tight. Dollar LIBOR, the rate that banks charge each other for short-term loans, fell across all terms. The TED spread fell 21 basis points to 436 basis points. The TED spread measures the difference between what banks charge each other for 3-month loans, otherwise known as 3-month LIBOR, and what the Treasury pays, as seen through the 3-month T-bill. Earnings were mixed. Johnson & Johnson posted third-quarter earnings growth that topped estimates and raised its full-year outlook. Conversely, PepsiCo reported smaller-than-expected earnings per share growth, excluding non-recurring items, gave a downside full-year earnings outlook, and announced job cuts. In commodity trading, oil prices came under selling pressure in conjunction with the pullback in stocks. Crude settled with a 2.3% loss at $79.35 per barrel after being up as much as 4.5% in Tuesday's session. Commodities as a whole fell 0.8%. Treasury prices declined as the government's plan helped calm financial markets. The 10-year note fell 24 ticks, sending its yield above 4% for the first time since August. I'm Pat O'Hare for Briefing.com. Thanks for listening.